the second part of the Speculators course, I'll be talking about the COT data and short or long squeezes. It's a phenomenon in the market. COT is short for commitment of traders. It gets published every Friday by the CFTC on the government website. The data is freely available. It is a great way of gauging what the sort of market participants are anticipating or how they are positioned in the market. The idea behind the COT data is that it creates a bit more transparency. So it's a futures market, shows you all the products, the commercials which are long or short, and also shows you the speculators or non-commercials who are long and short, and creates a bit more transparency in the market. You find there's sometimes extreme spots where commercials are extremely long or extremely short, and that causes a reversal sometimes. But when the non-commercials are extremely long or extremely short, then they're prone to getting squeezed. We had that, I'll show you a couple of examples in a wee moment as well, but we had that in 2018 and around January through to April, where Euro speculators were extremely long, and then they finally started getting squeezed and they had to close out all their long positions very rapidly, and that creates massive moves in a very short time span, which we try to exploit as well. Again, saying the COT data is freely available, but we have our in-house software that compiles all of that data and puts it down as a chart, so it's easier to decompose, it's easier to understand the different dynamics, the open interests, which shows basically how many contracts are live at any given time, and a reporting period shows you the averages and the maximums and the minimums of the commercials, and so on and so forth. So it's a little bit more detailed. I've done a separate tutorial explaining how the software works and how to understand it better, how to filter out. But let me show you when things are at the extremes, how far market could turn. So around 2018, starting from the end of January all the way to April, market was extremely Euro long. So it came to a point where it was they started to getting squeezed. To show you that on the charts, this is the Euro USD chart. It wasn't about this period. You could say it fits into sort of a noise box. Euro USD was extremely long against the backdrop, which wasn't probably as Euro positive, and they had to close out the longs very quickly, caused this massive 1200 pip drop. So that was a long squeeze on that point. We had the opposite as well in 2015. Let me show you on the COT tool. 2015 around March and April, and then again around in the end of 2015, we had the opposite, where market was extremely Euro short here in the first quarter of 2015, and you saw a good bounce back over again at 1100, 1200 pip, and the same thing happened again in November, where you saw the market got extremely to a point and then started getting squeezed. So we had a short squeeze. We tried to find these elements in the market and exploit that, because it creates quick and rapid moves, and most of the time gives the opportunity to jump on the trade very early and also very cheap with a lower risk exposure, as you would imagine. There are a lot of signals the COT tool generates, and some of them are a little bit simpler, some of them a bit more complex, some are trend changing, some are continuation within the trend. I've explained them all in this COT user guide tool. It's a 5-6 minute long video. It explains all of these signals as well. So if you go on YouTube and type in Speculators trading, it will be the video with the Forex COT user guide. Commodities, inflation, and producing countries are all linked together. Commodities, think of sugar, like soft commodities like sugar, coffee, cocoa beans, and base metals, which would then be like iron, zinc, or probably one of the most famous commodities is crude oil. So it all falls under commodities, and it's very important to analyze to understand inflation. Why? For instance, if the price of oil rises sharply, it does affect the petrol prices in the country, and that will affect transportation prices, and they will all reflect into the goods me and you buy as retailers, and that causes higher inflation, and they will trigger the central banks to tighten the monetary policy and start even rising interest rates. So commodities as a main, and especially oil, are very important to understand these bigger trends, and also central banks thinking, which then feeds back into bond yields. It's all entirely correlated. It's a big web of information or a chain, as you may say, where when one moves you get a chain reaction, ripples through the entire system. There's also producing countries that benefit a lot from specific commodities going up and down in price. For instance, Australia is one of the biggest miners of iron ore, also produces gold, and also LNG gas, one of the biggest exporters in the world. Actually, the second biggest exporter of LNG gas in the world is Australia. So you find that when Australian dollars goes up and down in price, it's most of the times affected by these commodities. Actually, something interesting was I believe it was in 2017, Qatar, which is the biggest exporter of LNG gas, started to have some problems with their ports, and they weren't able to export LNG gas for a very short period of time. And then you found that the Australian dollar was rallying really hard, like I'm talking 120, 130 pips a day for several days. And a lot of analysts and a lot of traders couldn't make sense why that's happening. The reason was that Qatar, which is a big LNG exporter, wasn't able to export anymore for a short time span because of the issues they had, and Australia was taking over doing that exportation of LNG gas for them. So we're taking in a lot of money, and a lot of customers were buying LNG gas from Australia, obviously exchanging their local currency into Australian dollar, and hence that moved the Australian dollar further up. So there's a lot of logic involved in understanding producing countries and what commodities move when. Always creates good opportunities on the trading side. Let's have a quick look at the charts just to cycle through these as well. So this chart here, I'm looking at the 4-hourly soybean futures. Let's have a look even at the crude oil. That's crude oil, and you find that again some of these commodities are closely correlated with the currency of a particular country. For instance, oil. There's a lot of countries that produce oil. And one of the major ones you find you trade in the FX spot market is the Canadian dollar. So if I were to show you the Canadian dollar futures, you find that it's very closely correlated to the price of oil. Higher oil prices means Canadian dollar will outperform. Lower oil prices will find the Canadian dollar declining as well. You find there's a close correlation in there. And sometimes these correlations break up because of political reasons, and they always tend to snap back eventually. So there's even sometimes a gap trade. We can make money out of that too. Some of the other countries that are major producers of some of the other commodities that you find that they will move a particular currency is, for instance, the Norwegian krone. That is one of the major oil producers in the world, and the price of oil tends to move the currency as well. Let's have a look at iron ore futures, because Australia is one of the biggest miners of iron ore and also exports it. So it's on a weekly chart. I'm going to compare that to AUD/USD, and you might find there were some spots where it decoupled for one move and one move the other way, but the majority of the time, again, these bubbles or these divergences tend to close the gap. So you can see I had a major bottom iron ore, so same was for the Australian dollar, and then it got caught in this bigger triangle, and more or less Australian dollar was following up as well, until recently there was a bit of a decoupling, and then it found its way back up again a little bit. So that's to the Australian dollar iron ore futures. Talked about inflation again. When the particular commodities go higher in price, especially oil, you find that the inflation globally will go up as well, and that will create a response from the central banks to curb inflation, usually by tightening monetary policy. Here's a chart of natural gas on the 4-hourly, overlaid with the Russian ruble over dollar. You find that a lot of these swings are in tandem as well, as Russia is one of the major exporters and producers of natural gas. And there's a lot of correlations and a lot of countries. It's just when you analyze this particular currency as part of your core analysis, you always want to have a look at the commodity that the country is producing, just to gain a little bit more insight. There might be some clues to where the commodity is headed, and that will give you clues into where the currency of the particular country is headed as well.